Good day everyone. Welcome to Unit 2 of the course Modern Banking. In this unit, we will explore the various facets of the Indian banking system, including the role of the Reserve Bank of India, the structure of commercial banks and rural banking, the challenges faced by the Indian system and its future prospects also. Let's begin by looking at the foundation of this system, the central bank. In India, the Reserve Bank of India is the central bank. The Reserve Bank of India, that is RBI, was established in 1935, is the apex monetary authority in India. The core functions of RBI are: it's the lender of the last resort. The RBI ensures liquidity in times of financial distress. It is the currency manager, that is, it oversees the issuance, circulation, and stability of the Indian rupee. It's the regulator and supervisor. RBI monitors and regulates banks to ensure financial soundness and customer confidence. It ensures financial inclusion, that is, it spearheads initiatives to include marginalized communities into the financial ecosystem. Its overarching role is to ensure the stability of the financial system while fostering economic growth. One of RBI's primary responsibilities is the formulation and implementation of monetary policy. The purpose why monetary policy is required is to regulate money supply and credit in the economy, to balance inflation and growth. So tools like repo rate, reserve repo rate and the monetary policy committee's decision are crucial in maintaining economic equilibrium. To maintain a robust banking system, the RBI ensures that banks operate efficiently and ethically. It audits bank and financial stability and compliance. This supervision prevents banking frauds and mitigates risk to a broader economy. Such oversight is vital to maintain public trust in the financial system. Credit control is one of the most powerful tools used by the RBI to regulate economic activity. Let me explain these measures in detail. The objective of credit control is to regulate the flow of credit in the economy, to control inflation, stabilize prices, and promote growth. So, the different types of credit control measures are quantitative credit control, which targets the overall volume of credit, and selective credit control, which focuses on specific sectors or activities. Quantitative tools are broad in their application and aim to regulate credit supply in the economy as a whole. Key instruments include bank rate, the rate at which the RBI lends to commercial banks. Raising this rate discourages borrowing and reduces credit availability, which controls inflation. CRR, that is cash reserve ratio, a portion that banks deposit must hold with RBI. Increasing the CRR limits the funds banks can lend, reducing money supply. Statutory liquidity ratio, or SLR, the percentage of deposits banks must invest in government securities. Higher SLR requirements can reduce credit flow to the market. Open market operations, or OMO, buying and selling government securities to influence liquidity. Selling securities reduces money supply, while buying securities increases it. The selective credit controls target specific sectors to encourage or restrict credit flow based on economic priorities. Key instruments include margin requirements. The proportion of borrowers' owns funds required for a loan. Higher margins reduce speculative activities. Credit rationing. Limits set on loans to certain sectors to prevent over-lending. Direct action. The RBI can penalize banks not adhering to credit control guidelines or engaging in non-prudential practices. The State Bank of India is India's largest commercial bank, deeply integrated into the economy. Key attributes of State Bank of India are extensive reach across urban and rural areas, diverse product offerings from savings account to corporate loans, a major player in financial inclusion, especially in rural India. SBI's support from the government ensures its stability and reliability in catering to the nation's needs. Commercial banks are essential intermediaries in the economy. The roles played by commercial banks are accepting deposits and providing loans, offering financial products like credit cards and investment services. By channeling savings into investments, they fuel economic growth and innovation. Let's have a look at rural financing. Rural financing is critical to India's socio-economic development. Institutions include included are commercial banks who extend credit for agriculture and small scale industries, regional rural banks which are tailored solutions for rural credit needs, cooperative banks which provide affordable financial services at the grassroots, and the regional rural banks who address the unique financial needs of rural areas. Their focus on agricultural credit fosters productivity and food security. By reaching unserved areas, RRBs promote financial inclusion and equitable development. Cooperative banks are grassroots institutions where members collectively own and manage operations. Cooperative banks are in three tiers. First, primary agricultural cooperative societies, village level support to farmers. District central cooperative societies provide financial services at the district level. State cooperative societies who are institutions at the state level who emphasize on agriculture and small business credit to enhance rural prosperity. Now let's have a look at the challenges that Indian banking system is facing. The major challenge which Indian banking system faces are non-performing assets or NPAs, a rising concern especially in agriculture and infrastructure sectors of NPAs. The competition, intense rivalry among domestic and international banks pressurizes profitability. Technological disruption requires significant investment in digital transformation. Regulatory compliance, growing complexity increases operational burdens. Now let's see what is going to be the future of Indian banking. Despite these challenges, the future of Indian banking is quite promising. Digital transformation has happened by technology which is driving, innovating and enhancing customer convenience. There is financial inclusion where greater efforts are taken to bring into banking sector the marginalized communities, and sustainability and resilience is brought about by robust regulations and innovative practices which shape the next phase of growth. So as a summary, these are the advances which ensure that the Indian banking system remains a cornerstone of the nation's economic progress. So with this, we have come to the end of this unit 2, wherein we had actually seen which is the core of banking, that is the central bank, that is the heart of the banking system. The commercial banks which are which help the customers by lending and lending loans and by accepting their deposits. And then we went to rural financing where we saw about RRBs and cooperative banks. And then finally, we also had forecasted what could be the future of modern banking in spite of all the challenges which the banking sector is facing because of the technological developments and the expectation of the customers. So after this, we go to unit 3.